Thank you for joining us for the presentation today. My name is Rich Wilbur, Director of Compliance and Administration with Hartman Employee Benefits. This presentation, of course, is not intended to replace any tax or legal counsel. It's for educational purposes only. You may reference resources on our website, or at the end of the presentation will be my direct contact information. You can reach out to me with any questions or clarification. This presentation was previously approved for education credit through HRCI as well as SHRM. The webinar on its own does not qualify for credit, but if you would like this presentation made for credit to a group, you can reach out to us to schedule that. So the quick background on the reporting: there are two sections of the Internal Revenue Code that require year-end reporting to the IRS. Under Section 6055, providers of minimum essential coverage are required to report. This becomes an employer obligation only when the plan is self-insured. If the plan is fully insured, it remains a carrier obligation. This reporting will document to the IRS compliance with the individual mandate, reporting individual enrollment by month for the employee, spouse, and children. This will be accomplished on Forms 1094B and 1095B for an insurance carrier or a small employer who is not considered an applicable large employer. So a small self-funded employer is using the B series forms. The C series forms would be used by a self-funded employer who is also an applicable large employer, and that applicable large employer will also be subject to the reporting requirements under Section 6056. Under 6056, an employer is reporting to the IRS their offers of coverage documenting their compliance with the employer mandate. Whether coverage was offered or not by the group, if they're an applicable large employer, as defined by 50 or more full-time employees, including equivalents, this reporting will be required by that employer group. They will use Forms 1094C and 1095C. And the C series forms have been built to accomplish both the 6055 and 56 reporting if the employer is subject to both. For the reporting process and timeline, I won't go into too much detail here. This is pretty straightforward and available in the instruction set. Basically, the reporting to the IRS must occur by the end of February if being filed on paper, or by the end of March if being filed electronically. But the timeline, I feel, is really driven by the deadline for providing the statements to the employees, which is by the end of January. That's really going to be the bulk of the work, and so getting those 1095C forms completed by the end of January will really be the driver of your process and timeline. There is a process by which you can request extensions and waivers to some of these requirements. However, I feel most employers will make an effort to comply within the normal timely filing. There are penalties associated with non-filing. I'm going to assume that everybody viewing this webinar is doing so with the intent to file correct and accurate information in a timely way. I will point out that for 2015 specifically, the IRS has communicated that a good faith effort made by the filer would not result in any penalty for incorrect or incomplete information. So as long as you're giving this a best good faith effort and getting them out the door on time, there would be no penalties. However, the penalties related to the actual employer mandate or the individual mandate would still apply. The penalties that the IRS is sort of willing to waive are specific to incomplete or inaccurate information. So this is the Form 1095C. I mentioned earlier that some small self-funded employers would be reporting on the 1095B form. I'm going to focus on the C series form as I believe that would be the more common application here. The form is broken into three parts. The first part, really pretty straightforward information, basic employee information including the name, address, social security number, as well as employer information, which is the name of the employer, their EIN, address, and a contact telephone number. Section 2 is really where the kind of bulk of the reporting occurs, where some of the confusion lies, and where the details are really important. You'll be entering your plan start month on the top row. Then on row 14, you'll be entering a code, a 1 series code, that describes the offer of coverage that occurred, if one occurred. Row 15 will detail what the cost of that coverage was, and row 16 will apply a safe harbor code, if applicable, which will protect the employer in that month from any sort of penalty risk, basically defining to the IRS that the offer of coverage met one of the appropriate safe harbors that protects that employer from the employer mandate penalty. And then part 3, this is the section that is only completed if the employer is self-insured. The first line has a checkbox asking if the employer provides self-insured coverage. If that is correct and that box is checked yes, then you'll complete the rows below, documenting each individual person, the employee, spouse, and child who is enrolled, their social security number, and the months in which they were covered. That is the section 6055 reporting requirement for self-insured plans, which if the plan is fully insured, this information is completed by the carrier on the B series form. So the intent of this presentation is to go through a case study. So I'm going to try not to just read straight instructions to you. I'll illustrate the case study. But the one thing I wanted to point out, specifically on part 2, line 14, the offer of coverage code. One specific detail here that's really important to understand is that an offer of coverage must have been offered or provided for every day of that month. So if for any reason you are offering coverage to someone that starts mid-month or potentially ends mid-month, depending on a new hire waiting period or end of employment or something like that, technically that is not an offer of coverage as it was not offered for every day of that month. An additional detail on line 15 is that line 15 really depends on line 14. There are certain codes that will trigger a reporting requirement on line 15, but other codes where it's permissible to leave line 15 blank. Lastly, for line 16, the 2 series code, if applicable, there are instances where more than one code could apply, and we'll talk about the rules for which one should apply first, but there are also scenarios where perhaps no code is entered in there. And a blank space, while it is permissible, should highlight to the employer a potential opportunity for penalty. It doesn't on its own definitely trigger a penalty, but a potential penalty liability would exist there if no safe harbor can be documented. For line 14, the 1 series codes that I've referenced are laid out here. I've highlighted the ones that I think are sort of most common to occur. And there's some jargon here. So 1A represents minimum essential coverage. That's MEC or MEC. That is also minimum value. Minimum value coverage being the 60% or greater actuarial value. 1A also requires that offer of coverage meet the federal poverty line affordability safe harbor, which is that the cost of single-only enrollment doesn't exceed 9.5% of the individual poverty line in the United States, and that offer of coverage must be extended to an employee, spouse, and children. Code 1E, for example, is the exact same, with the only difference being that the offer of coverage perhaps does not meet the affordability safe harbor related to the federal poverty line. So if you're offering minimum essential, minimum value coverage to an employee and spouse and children, but it does not happen to conform to the federal poverty line affordability safe harbor, then your offer of coverage is 1E as opposed to 1A. 1B, C, and D is similar, but with varying offers of eligibility as it relates to the spouse and children. 1B would be spouse and children not being eligible at all. 1C excluding spouses. 1D excluding children. There are many plans that have a conditional eligibility for spouses, where perhaps the spouse is only eligible if they are not otherwise eligible for their own employer plan. A conditional eligibility for spouses is still considered to be an offer of coverage to that spouse. So if you have a conditional offer of eligibility for spouses, you would still use 1A or 1E accordingly, that spouse is in fact eligible if there's not some other condition that sort of removes them. Code 1F is minimum essential coverage that does not meet the minimum value standard. Oftentimes these are referred to as skinny plans, but a plan that does not meet that 60% actuarial value. Code 1G would be an offer of coverage to a non-full-time employee. This can happen in a variety of situations, including, for example, if an employer offers coverage to non-employee directors, perhaps, or a COBRA participant that is still an employee, but perhaps their hours were reduced, which triggered that COBRA event. A terminated employee will be treated differently as it relates to COBRA, and I'll illustrate that later on. Code 1H is no offer of coverage at all. So this could occur for a variety of reasons. Perhaps the employee just simply did not offer coverage to that full-time person, or in certain calendar months where perhaps the employee was not offered coverage because they weren't employed in that month, perhaps. Code 1I is related to qualifying offer transition relief, and really for this one I'm going to point you back to the direction set. There's some clarification there and some detail that is meaningful, but takes a little bit more time to step through, and I believe will be less likely for the 2015 reporting for many employers. For line 15, you're going to complete this line only if certain codes are entered into line 14. So if the code is 1B, C, D, or E in line 14, you will be expected to enter the cost information. However, if the code is 1A, for example, no cost information is necessary because code 1A already separately communicates that the offer was affordable based on the FPL safe harbor. Similarly, if the code is 1H, that there was no offer of coverage, well, of course, it doesn't matter what it cost because there was no offer. So only certain codes will trigger a necessary entry into line 15. But then on line 15, what you're entering is the employee share for self-only enrollment. So of course, it doesn't matter what the total cost of premium is, just what the employee would be contributing. And it doesn't matter what they would contribute to enroll a spouse or dependent child. It's only what they contribute to enroll just themselves only in the lowest cost monthly premium plan that is minimum essential and minimum value. So if the employer offers multiple plans and all qualify as minimum essential and minimum value, you're going to be reporting based on what the lowest cost option would be that is offered to that employee. Also, the IRS wants you to be precise and include any cents, not just the dollar amount, but any cents. And they provide a calculation specifically to arrive at that monthly cost. If, for example, the employer's payroll deduction runs on a, let's say, a biweekly payroll deduction cycle, you can take the number of, or the total sort of cost to enroll across the entire plan year for all the pay periods that occur in that plan year, and then divide by the number of months within that plan year to get to the monthly equivalent. Line 16 contains the two series codes, which are the safe harbor codes communicating to the IRS that an offer of coverage was compliant and that there couldn't be a penalty assessed to the employer for that month. 2A is a code implying that the employee was not employed on any day of that calendar month. 2B is a code implying that the employee was not full-time for the entire month of that calendar year. Now, the full-time distinction here is important to understand that has to be on the first and last day of the month. So if an employee was full-time but only for part of the month, they do not qualify as full-time for that month as it relates to the reporting requirement. 2C communicates that the employee enrolled in coverage and that they were enrolled for every day of that month from the first through the last day of the month. I have an asterisk notation after 2C with a footnote at the bottom that communicates that the IRS really wants 2C to be the sort of dominant code here, that in any month where the person was enrolled and qualifies for code 2C, 2C should take precedence over all of the other codes that might also apply. 2D is communicating that the employee was in a limited non-assessment period. I'm going to define this term in more detail later on in the presentation, but this is basically communicating a month where the employee may be full-time and otherwise identified as benefits eligible. However, they're within a month that the IRS cannot penalize the employer under some permissible structure, such as like a new hire waiting period would be an example, where yes, the person was full-time in that month, but the employer did not offer coverage, and it was perfectly acceptable and compliant because they were within a compliant and sort of normally structured new hire waiting period. That would be an example of a limited non-assessment period. Code 2E, on this one I'm going to point you back to the instructions. This is multi-employer interim rule relief, where an employer perhaps doesn't offer their own plan, but their employees, perhaps through a collective bargaining arrangement or union group, may be offered coverage through a multi-employer plan. It's a bit case specific, and I'll point to the instructions for that one. 2F, 2G, and 2H are all codes communicating to the IRS that the offer of coverage was affordable for that individual based on any of the three affordability safe harbors, 2F being the W-2 affordability, 2G based on federal poverty line, and 2H based on rate of pay. And again, that's communicating that the employee's cost for single-only enrollment did not exceed 9.5% of each of those three criteria. Code 2I communicates non-calendar year transition relief. Keep in mind that this reporting is done on a calendar year basis, so for 2015 calendar year, but an employer is only obligated to comply with the employer mandate as it relates to their plan year, as long as they qualify for that non-calendar year transition relief. So for example, a plan that starts in July, let's say the first 6 months of that plan year, January through June, the first 6 months of that calendar year, January through June, actually are attached to that employer's 2014 plan year, and they may be able to use code 2I in that scenario. I mentioned the term limited non-assessment period in the last slide. This is an important term to understand both how it works and in what situations it could apply. But generally speaking, this is a period of time where an employer will not be subject to an assessable payment for a full-time employee, regardless of whether or not that employee is offered coverage. So I gave the example of a new hire waiting period. It's also important to know, though, that to use this limited non-assessment period protection, there's another aspect that you have to comply with, which is that at the end of that period, the individual actually has to be offered coverage. You can't apply a limited non-assessment period and say, well, for let's say a 2-month new hire waiting period, we can't be assessed a penalty, but then at the end of that waiting period, we didn't actually offer coverage anyway. The limited non-assessment period protection would go away in that instance, and that 2-month waiting period, for example, would not then qualify. 6 specific examples of the limited non-assessment period are laid out here. The ones that I'll point to, I guess, in specific detail would be 2 and 3, where whether you're using a monthly measurement method or a look-back measurement method, a standard new hire waiting period within that construct would qualify. Additionally, if you're using a look-back measurement method and the employee at time of hire is classified as a variable hour employee and unclear if they're going to be full-time, and you apply an initial measurement period and an administrative period to average that individual's hours, the period of time where that employee is in the initial measurement period and immediately following administrative period, those periods where there was no coverage offered would also qualify for the limited non-assessment period protection. For the Form 1095-C, specifically referring to Part 3 now, Part 3 is only completed if the employer is self-insured. You'll put a check in the box if necessary, and then there was a lot of confusion around whether or not reporting for HRAs is required. Back in August, there was some instruction released implying that HRA reporting would be required, and then it was clarified in mid-September that that only actually applied in certain specific situations. And that is when an employer offers an HRA where there could be enrollment in the HRA or health reimbursement arrangement that does not match the enrollment in their group health plan. So for any employer, whether self-insured or fully insured, if their HRA has identical enrollment where the eligibility for the HRA is driven by the eligibility for the group health plan, or participation in the group health plan, then the HRA does not need to be separately reported. However, if an employer offers an HRA, and this could occur in an example of a spousal HRA, where that health reimbursement arrangement integrates with an employer plan at the spouse's employer and reimburses out-of-pocket costs under that spouse's employer plan, then you have enrollment in your HRA that does not necessarily match the enrollment in your qualified health plan. And in that instance, separate reporting would be done for the HRA, treating the HRA as a self-funded group health plan and completing Part 3. Additionally, you'll be creating one 1095-C form per full-time employee if the plan is fully insured. You're documenting to the IRS for each full-time employee was an offer of coverage made, and so it will be one form per full-time employee. Anyone who is not full-time for any month of the calendar year would not receive a form unless the plan is self-insured, and then you'll be completing a 1095-C form for both every full-time employee as well as any employee who is actually enrolled for any month in the calendar year. Because you also then have to comply with the 6055 reporting requirements documenting individual enrollment, it would also include anyone who was enrolled in the plan during that year. So we'll jump into the case study here to illustrate the completion of a 1095-C form. My example company is ACME Inc. They had 59 employees who started and ended the year as full-time employees. Now, I'm going to illustrate one example later on in the presentation that's a far more complicated example, but in many instances, an employer will have at least some grouping of employees who have really relatively straightforward reporting requirements, and this is what I'm attempting to illustrate here. So let's assume that these 59 employees were all full-time on the first and last day of the year. They had previously satisfied any new hire waiting period, so that would not apply. Now, ACME Inc. offered minimum essential and minimum value coverage to the employee, spouse, and children. For the first 6 months of the year, the plan was fully insured with a $200 per month cost for single-only enrollment. For the last 6 months of the year, the plan was self-insured, and the employer switched to a contribution structure that they paid 100% of the single rate, and so the employee paid nothing. Now I'm going to give two examples here, one employee who is enrolled for all 12 months and one employee who waived coverage for all 12 months. So the completion of the Form 1095-C for our first employee, Robert enrolled. This was the employee who was enrolled for all 12 months. His name, social, and address are included in Part 1, along with the employer name, tax ID, address, and contact telephone number. In Part 2, we enter the plan start month, which is July, corresponding to 07. And then for row 14, the offer of coverage in the first 6 months from January through June, remember it was minimum essential, minimum value coverage offered to the employee, spouse, and dependent. It did not on its own meet any of the affordability safe harbors, specifically the FPL safe harbor, and so code 1E is what we can use to document that offer of coverage. For the last 6 months of the year, July through December, recall that the employer changed their contribution strategy to pay 100% of the single rate, therefore meeting the federal poverty line affordability safe harbor, and code 1A can be used. For line 15, for the first 6 months of the year, the lowest cost self-only enrollment coverage costs $200 per month. But for July through December, we do not have to enter any information in there. If you recall that line 15 does not require any information if code 1A is used. 1A already communicates that the plan was affordable, and so the cost information does not need to be entered. And then for this individual who is enrolled for all 12 months, in the first box there, the column says all 12 months, and they can put 2C. 2C communicates, yes, this individual was enrolled. Now for part 3, yes, this plan was self-insured for some portion of the calendar year, so we'll check the box. We will enter the name of the employee and their spouse who enrolled along with them, their social security numbers, as well as the months in which they had at least 1 day of enrollment in the plan. There would be nothing reported for January through June because the plan at that time was fully insured, and the insurance carrier would be providing that reporting on the B series form. Our second example would be an employee who waived. Cheryl waived for all 12 months. Her social security number, address, employer name, tax ID, and address, and contact information. 07 was the July start month of the plan year. Now this employee, even though they waived coverage, received the same offer of coverage from the employer, minimum essential, minimum value offered to employee, spouse, and dependent, code 1E. July, again, they changed to paying 100% of the single rate, code 1A, Same offer of coverage, but it also now meets the federal poverty line affordability safe harbor. Row 15, the single cost self-only enrollment was $200, and that's entered there. July through December does not need to be completed because Code 1A documents that the plan was already affordable. So from the prior slide to this one, the employee who enrolled and the employee who waived, lines 14 and 15 look identical because they received the same offer of coverage, the same potential cost of coverage. Whether they enrolled or not doesn't have any bearing on line 14 or 15. So the only difference for this employee will be starting on line 16, where I'm entering code 2I. 2I was the non-calendar year transition relief. So whether that offer of coverage from January through June was sort of compliant or not, being minimum value and affordable, it doesn't actually matter because that was part of this employer's 2014 plan year, and they're not obligated to comply with the employer mandate until the first day of the 2015 plan year because they qualify for non-calendar year transition relief. Code 2I represents that. For the last 6 months of the year, this employee did not enroll, so we cannot use code 2C. Instead, we can use 2G that communicates this offer of coverage met the federal poverty level safe harbor for affordability, which is somewhat redundant with line 14 being code 1A, but it is a safe harbor that still protects this employer from any penalty and can be included there in line 16. This plan was also self-insured for part of the year. However, Cheryl never enrolled, so Part 3 would not be completed for Cheryl because the employer, the issuer of coverage in this instance, cannot document for any month of the year that she was enrolled in minimum essential coverage. If she had coverage elsewhere, the issuer of that plan would be providing that reporting for her, likely on the B series form. I wanted to highlight the non-calendar year transition relief code that I used in line 16. If, for example, this plan was not a non-calendar year plan, if it was a calendar year plan, or if they did not qualify for the non-calendar year transition relief based on some of the other disqualifying criteria, there could have been other codes that perhaps applied there. For example, 2F or 2H, if that $200 monthly cost to enroll met the W-2 safe harbor for Cheryl's year-end W-2 Box 1 income, or if it met affordability measures for her actual rate of pay, one of the affordability safe harbors could have applied there. Additionally, if that $200 cost exceeded an affordability safe harbor for her, those boxes could have remained blank. Now, a blank form, or a blank space, I should say, on row 16 is permissible. It would just potentially open that employer up to a penalty if that employee went to the individual market and was subsidized, and it turned out that that offer of coverage, for example, was not affordable based on their household income, then that could result in penalty. But using code 2I allows the employer to state to the IRS, we cannot be penalized for this month based on this safe harbor. So continuing on with the case study, I just stepped through the sort of simple examples of someone who was kind of consistently enrolled or waived through the entire 12 months. This case example will be far more complicated in an attempt to illustrate more codes. So our example employee here is Tom Complicated. Tom was hired on February 1st of 2015 in a part-time position. He was promoted to a full-time position on March 1st and had an annual salary of $25,000 a year. Acme Inc. offered minimum essential and minimum value coverage to the employee, Tom, as well as his spouse and children after the completion of the new hire waiting period, which ended on April 1st. The cost of that coverage would have been $200 per month for single-only enrollment. And I have a notation here that just shows, based on Tom's $25,000 a year salary, at 9.5% of that, divided by 12 months, the cost that would have met his affordability safe harbor, either based on his rate of pay or as a sort of estimate of his Box 1 W-2 income, would have been $197.91. And because this actual coverage cost was $200, this employer would not be able to use any of the affordability safe harbors for his offer of coverage. I'm also noting here that he actually initially waived coverage on that April 1st date and enrolled in his spouse's plan. Now, his spouse's employer introduced a spousal carve-out effective May 1st, which caused Tom to come off of the plan, come off of the spouse's plan, and enroll in ACME's plan based on that qualifying loss of coverage. Progressing through the year here for our case study for Tom, ACME moves to a self-insured plan on July 1st and changes the contribution rate to 100% of the single rate. Tom continues his enrollment as a single individual. His wife Susan quits her job and loses coverage on August 1st, and Tom enrolls her in his plan using that qualifying loss of coverage. They have a child named Billy, who's born September 4th, and as of the child's date of birth, they enroll him in ACME's plan. Tom quits his job in the middle of October, on October 25th. His coverage ends immediately on date of termination of employment, and ACME offers him COBRA coverage. Tom elects to continue the COBRA coverage for his family for November, for the end of October and for November, but then drops that coverage when he finds new employment with new health benefits December 1st. So obviously an intentionally complicated case study here. I'll use it to illustrate the series of codes that would apply in each of these scenarios. So for the Form 1095-C, Part 1, the basics. We already have gone through this. Employee's name, social address, employer name, tax ID, address, and contact phone number. Part 1 is now complete. For Part 2, taking this 1 month at a time, the initial month of January, keep in mind that Tom was hired on February 1st. So for the month of January, there was no offer of coverage, which is code 1H. And the safe harbor that applies is 2A, because the employee was not employed during that month of January. When we're completing the month of February, the employee was hired February 1st, so he was employed for all of February. However, keep in mind he was employed initially in a part-time capacity. So no offer of coverage, 1H. And the safe harbor that protects the employer here was that the employee was not full-time during the month of February, so there didn't have to be an offer of coverage. In completing March, Tom was promoted to full-time March 1st. He was full-time from March for the entire month of March, so he was a full-time employee there. However, he was in his new hire waiting period, so there was no offer of coverage until April 1st. So for the month of March, code 1H is no offer of coverage. And the safe harbor that applies is that the employee was within their limited non-assessment period. Recall we talked a bit about that as it relates to new hire waiting periods. This sort of 30-day or first month following 30-day new hire waiting period is permissible structure. Code 2D says, yes, this employee was full-time, but in a limited non-assessment period based on their new hire waiting period, and so there didn't have to be any offer of coverage. Completing this for April now, Tom was offered coverage April 1st. He chose not to enroll. He enrolled in his spouse's plan at that time, but the offer of coverage was made, and that's code 1E, representing minimum value coverage offered to the employee, spouse, and dependents. Because code 1E was used, line 15 now has to be completed with the cost information, which was $200. And because he waived coverage and because no affordability safe harbor applies, row 16 will actually be blank in this case. Now I have an asterisk there because after I complete the entire calendar year for Tom, I'm going to come back and show you a change to that. But to illustrate just this particular month, based on those criteria, there would be nothing included in line 16 for the month of April. This, to a certain extent, exposes the employer to penalty risk. However, in this exact scenario, because Tom ended up enrolling in the spouse's plan and not going to the individual market receiving subsidy, there wouldn't actually be a resulting penalty in that month. For the month of May, Tom actually ended up enrolling because his spouse's plan, remember, introduced a spousal carve-out. So he was sort of forced off of that plan and enrolled in ACME's plan. The offer of coverage didn't change. It was still 1E, and the cost of coverage didn't change, still $200, but the safe harbor that applies in row 16 changed to 2C, communicating that, yes, this employee actually then enrolled for each day in that calendar month. The month of June, nothing happened. There was no change in the offer. There was no change in enrollment. The codes for June match the same codes as May. For the month of July, July was the plan year or the plan start month, so 07 goes in plan start month representing July. The offer of coverage also changed in July. Recall that this plan moved to self-funded or self-insured, which that on its own doesn't change the codes, but it will change the impact on Section 3 of this form, which I'll get to a little bit later. But because the employer changed their rate of pay, or I'm sorry, their rate of contribution to the plan to pay 100% of the single rate, the offer code for 14, row 14, now complies with the 1 series code 1A, which says that this was affordable based on the federal poverty line affordability safe harbor. So for row 15, you don't have to enter any cost information because code 1A already communicates affordability. And for row 16, Tom remained enrolled, so 2C would represent his enrollment. For the month of August, recall that Tom's spouse left her job and Tom ended up enrolling her in his plan on August 1st. But adding her to the plan doesn't change the offer of coverage, so code 1A is still the corresponding code based on the offer of coverage. We still don't have to enter anything in row 15 because 1A communicates the affordability. And row 16 doesn't change because Tom still remains enrolled. It doesn't matter that the spouse came on the plan with him. For the month of September, the change that occurred here was that they had a child, and the child enrolled in the plan September 4th. But just like the month of August, there was no change in the offer, no change in the cost of the offer to the single enrollment, I should clarify. And there was no change in terms of Tom's enrollment, so codes 1A and 2C remain. So for the month of October, keep in mind that the employee terminated employment and the active coverage ended on October 25th. Even though the employee elected to continue that coverage under COBRA, code 1H is going to be used, indicating no offer of coverage because that offer was not made for every day within the calendar month. COBRA is a specific situation, a specific scenario that instruction is provided in the IRS instructions on these forms. And in any month where COBRA coverage is offered, you're going to report that using code 1H. Unless the employee actually maintains employment, and I'll speak to that specific example later on in the presentation. Additionally, for the safe harbor code in line 16, you're going to use the code 2B, indicating this employee was not full-time for the month, even though Tom was full-time from October 1st through his date of termination. Because he wasn't considered to be full-time for the entire month, you're going to use code 2B. For the month of November, there was COBRA coverage offered and COBRA was maintained, but you would use for row 14 1H, indicating that there was no offer of coverage. And the safe harbor code that would apply would be 2A, was that this employee was not employed any longer for that month. For December, same as November, 1H, no offer of coverage. 2A, the employee was not actually employed. Now in this instance, Tom's family maintained COBRA coverage for November, but not for December. That has no bearing on the offer codes or safe harbor codes that would apply in this scenario. Now I mentioned earlier that I would kind of circle back around on this. This employer, because of their plan year start date being in July, they actually could use non-calendar year transition relief for January through June. We could substitute 2I. For the codes that were previously provided in January through April. 2C, though, remember, still takes precedence, so that would still be communicated in May and June. And that would protect the employer from that month of April, which was previously a blank. Now, I didn't illustrate this the first time around simply because I wanted to step through these examples and illustrate the other codes, but given this employer's plan year start date of July, they could have used non-calendar year transition relief in the months of January through June if applicable. However, in this case, 2C applies in May and June because the enrollment actually occurred. There are a couple of different instances where COBRA can be treated differently. COBRA, you never report as an offer of coverage if the employee was terminated. However, if the employee was offered COBRA coverage because there was a reduction in hours, but they still remain employed, you would then actually still use the same offer codes that would have applied to an employee who remained employed during that calendar month. So because this employee was terminated, I used codes 1H and 2B. However, if this employee was offered coverage due to the reduction in hours, they were still then employed for the entire month of October, and there was an offer of coverage, but you would enter code 1G, communicating this was not a full-time employee. Recall that in order to be full-time, you have to be full-time for the entire calendar month, and that in this instance, the employee remained enrolled, so you would have used code 2C to communicate the enrollment in coverage, even though they were not considered to be full-time. Those specific codes do not apply to the scenario that I created. I just show them here as an alternative scenario in a COBRA situation. Part 3 of the 1095C form for self-funded plans, we do know that ACME changed to a self-funded plan as of July. So they do have to complete this. We'll put a check in the box that says yes, they had self-insured coverage. We put the employee information in here, not just the employee, but the spouse and child who were enrolled at any time during the year. We also include social security numbers. Now for Tom, he was enrolled in self-insured coverage from July through November. Keep in mind that he actually enrolled originally in May, but at the time the plan was fully insured. So for the enrollment for May and June, that would be reported by the fully insured carrier on the 1095B form. Also note that his enrollment in October shows up here, even though part of that month was a full-time employee and part of the month was COBRA. It also shows up for November, even though he was not employed, but he was enrolled under the plan. Now this reporting requirement for this section is different. The section 6055 requirement is documenting to the IRS any individual who is enrolled, not necessarily the offers of coverage. So because Tom was enrolled in the coverage, the employer as the issuer of the plan has an obligation to report to the IRS any minimum essential coverage that was that Tom was enrolled in for that year, so July through November. Susan was enrolled August through November, and the child was born in September and enrolled September through November. Recall that all of them dropped the COBRA coverage in December, and so there was no enrollment in this plan. They did enroll in Tom's plan through his new employer and the new benefits, and that enrollment would be reported separately under either that employer plan or that carrier on the B series form, or potentially the C series form if that employer were self-insured. So this is the complete form for Tom Complicated for all 3 sections of the form. And now we'll move on to the 1094C form. I'm not going to, I've kind of listed out the parts of the form here. I'm not going to read them to you directly. I'm actually just going to jump into the form and step you through it. There's some language in here that's important to understand, such as this authoritative transmittal. Again, I'll point you to the instruction set to get the clear definition of that. Also on the 1094C form, there's a section called these certifications of eligibility. These are pretty involved, and I will point you to the instruction set for those as well. I would be happy to talk you through them as they apply to each individual employer group. I will specifically point out the one which is the section 4980H transition relief. This could apply in 2 scenarios based on the employer's size, if they are 50 to 99 in their ALE count, in their FTE count as it relates to an ALE, or if they are 100 plus in their FTE count. And this is where the employer will have the ability to attest to the IRS that they qualify for the transition relief related to the employer mandate for the 2015 plan year. On the 3rd and 4th parts of the page, we'll complete this as we go along. But that first column documents if minimum essential coverage was offered, and specifically you have to verify that it was offered to 95% of employees and children, and there's a variation on that, which is actually a 70% threshold just for the 2015 year. So we will now jump into the case study for completion of the Form 1094C form. Our employer, Acme Inc., their HR director is Jane Doe. Acme had 60 employees over the course of 2015. Recall that 59 of them I sort of included in the simple examples of the enrollments and waivers earlier in the presentation. The additional one, of course, would be Tom Complicated. So 60 total full-time employees were reported at some point during the year. Acme owns 100% of Subsidiary Inc. The full-time equivalency count of the controlled group was 59, qualifying for 4980H, the employer mandate transition relief for employers of size 50 to 99. And Acme Inc.'s health plan renews July 1, as we previously discussed. So the 1094C form will look like this. The completion of this information for Acme, we enter the employer's name, the employer tax ID and address, the person to contact, Jane Doe in this case, the HR director, and the contact information. Lines 9 through 16 only get completed if you are a designated government entity filing on behalf of another government entity. So again, a specific case scenario there, I'd point you to the instructions if you feel that may apply to your group. Line 18 asks for the total number of Forms 1095C submitted with this transmittal. So this transmittal to the IRS is going to be one 1094C form and 60 1095C forms submitted along with it. There are instances where you can submit more than one transmittal to the IRS. You could sort of submit these in batches, for example. In my example, they're all being submitted at the same time, all 60 of them. Row 19, is this the authoritative transmittal for this ALE member? The answer is yes. Every employer with a tax ID and EIN number will be completing this reporting themselves. So even if you're part of an aggregated ALE group, a controlled group with common ownership, every employer within that group will have to do their own reporting based on their own EIN and their own employees. Each of those employers will be required to submit an authoritative transmittal. That's sort of their final transmittal. However, to my prior comment about some employers being able to submit these in batches, if you were submitting just a batch of 1095C forms, you do include this as a cover sheet, but that cover sheet does not get the full completion as the authoritative transmittal. That's not going to come up too frequently. I don't believe there's an example spelled out in the IRS instructions on the form that you can read through. In general, though, for every employer that's going to be completing this, they're generally going to be completing this as the authoritative transmittal for their EIN. Row 20, the total number of 1095C forms filed on behalf of this ALE. In my example, all 60 are being submitted at this one time as a batch, so the same number will appear on row 18 as well as row 20. The total number of forms being submitted with this form is 60, and the total number of all forms being submitted on behalf of this employer is 60. Row 21, is this ALE member a member of an aggregated ALE group? So is this employer part of a group of employers under common ownership or controlled group status as it relates to the employer mandate? In this example, the answer is yes. As I mentioned, they own 100% of Subsidiary Inc. Row 22 relates to these certifications of eligibility, which previously in the presentation I kind of pointed you back to the instruction set. This employer does qualify for the qualifying offer method transition relief, as well as section 4988H transition relief. C is really the most important one there in my opinion. A, B, and D potentially qualify the employer for simplified reporting. However, I would argue that it's not all that simplified, because where it does permit certain instances where an employer can provide a simplified statement to the employee, they still have to complete the Form 1095C for the IRS. So I would argue that it doesn't really add all that much simplicity to the reporting requirement. Though certification of eligibility for C, the section 4988H transition relief, is an important one as it relates to the maximum penalty calculation for the employer. Bottom of the form would be signed with the title and date. On the second page, or part 3 of the 1094-C form, column A asks about minimum essential coverage offered. In this case, for Acme Inc., the answer is yes, that they met the threshold of offering coverage to their 95% of employees, or 70% for 2015, and they met that for all 12 months. If that was met separately for some months but not others, you could go down through the rows representing the calendar months and just check off those months. In this case, it was met immediately for all 12 months. Column B asks for the number of full-time employees for that ALE member. In this instance, I'm showing the transition over the year from 59 up to 60 when Tom Complicated came on board, and then back down to 59 after he left. And I'll contrast that with column C that represents the total employee count. So the total employee count, of course, would include, for example, part-time employees, whereas the full-time employee count would not. So there's going to be some obvious differences there. However, in my scenario, I want to point out a couple of these. In the month of February, if you recall, that was the month that Tom Complicated was initially hired as a part-time employee. So he does not show up in column B, but he does show up in column C. Notice, however, in March was the month that Tom was employed as a full-time employee. But he does not show up in column B yet, because even though he was considered full-time, he was in his new hire waiting period, which recall was that term limited non-assessment period. Any month in which an employee is in a limited non-assessment period, they are not yet considered full-time for purposes of this count. I equate this to really what the IRS is asking for here is for the employer to disclose how many employees could we actually penalize you for if there was a failure to offer coverage. And because the employee was in a limited non-assessment period and there could be no penalty assessed, they also don't get included in this count for the full-time employee count for column B. Additionally, in the month of October, Tom was employed through October 25th, but because he wasn't considered full-time for the entire month, he does not get counted in that full-time count for column B there either, though he does show up in column C as an employee in that month. Column D asks about aggregated group indicator. So if an employer is part of an aggregated group based on controlled group or common ownership, that box would be checked for all 12 months or each month separately where that would apply. And then for column E, section 4980H transition relief indicator. There are two codes that could apply here, code A or B. Code A communicates that the employer had an FTE count, a full-time equivalency count, between 50 and 99, and that they qualify for the transition relief under the employer mandate, that for an employer within that size does not have any employer mandate penalty for the 2015 plan year. Code B would be for an employer with 100 or more full-time equivalent employee count under the employer mandate, where a penalty could potentially apply. However, keep in mind that for the 2015 plan year, the maximum penalty calculation changed to an exemption for the first 80 employees as opposed to an exemption for the first 30 as the law was originally written. So code A for a 50 to 99 size ALE member, and code B for a 100 plus ALE. Last page of the Form 1094-C simply asks you to list out other ALE members of your aggregated group. In this case, Acme owns 100% of Subsidiary Inc., so I have them listed there. Of course, if your employer group does not have any other members within an aggregated group, you would leave this section blank. So that is the end of our presentation and case study. I hope it was helpful. If you have any questions, please feel free to reach out to me. My contact information is provided here. You may call or email at your convenience. There will also be additional reference material posted to our website at the web address provided there. Thank you very much.